We're in the best industry on earth, innovation, technology. If you ask me, is venture as an asset class and technology as an asset class, are they bigger or smaller in 10 years? The answer is obviously bigger.
Tom, I am so excited for this. I've obviously heard so many wonderful things from Somesh, so thank you so much for joining me today.
I'm stoked to be on the show. Thanks for having me.
Not at all, but I want to start with a little bit on you, okay? So how did you make your way into the world of venture? And then how did you come to be a partner at IVP today?
My dad was a serial entrepreneur. And mind you, these were like small 3 or 4 person companies. This was not anything big. But I think growing up around that energy, going into some big corporate job was just never really an option. And I also grew up in the 80s and 90s, like at the dawn of the internet, hacking around on PCs, and started a website in the 90s. And I knew I needed to be in technology. That was kind of the option, right? Like I knew it was going to be entrepreneurship plus technology. And so I went to Stanford in 1999, discovered venture, as they say, it was love at first sight, and wanted to find my fastest way into the career.
I love that. I agree with you in terms of finding the fastest way there. How did IVP come about?
IVP came about because I had a great mentor. That mentor is a guy named Eric Wiesen, and he spoke really highly of a couple of the partners at IVP, Jules Maltz, Eric Liao, and Somesh as well, as you referenced. And I got to know them on some boards, and one day they gave me an offer to join the firm, and I knew it was an equal partnership, so I jumped at it, and that was the beginning of 2015.
I mean, what a journey it's been since then. Now, I loved your Twitter thread. I read it, and I was going, yep, I'm so in agreement. Now, before we dive into the thread itself, I think it's helpful to set some context. And so, for you to set some context, what context would you like to set before we dive in?
First off, listen, there's a lot going on with the economy that doesn't have to do with entrepreneurs. And I think it's important to back up and think to yourself, like, the economy is actually in good shape. Public markets multiples are in a good spot. It's a wonderful time to start a company. But I also think it's important to acknowledge that the craziness that went on in 2020 and 21 isn't coming back. And there's some really profound implications for how you run your company. And that's why I wrote that thread. I wrote that thread to give actionable advice to our entrepreneurs and all the entrepreneurs out there today.
As I said, I thought it was the most brilliant breakdown. I want to just ask a couple of things before we dive in. You said about not going back to 2021. What does that actually mean? Does that mean 20% discounts, 50% discounts, structured rounds? Everyone says. So, what does that mean? What do these look like for those companies?
So I would say discounts are the wrong way of framing it, because you're just anchoring on something that was totally irrational in 20 or 21. It's all about the fundamentals. Is this a good business? What's the quality of revenue, the unit economics, the founder quality? And then, you have to think about what's the exit potential for this business and the probability. And in 21, those fundamentals, for whatever reason, right, macro, interest rates, whatever it is, I'm not a macroeconomist, people became unmoored from that. Diligence was being done in 24 hours by a lot of firms. Like that sort of thing, I think was actually unhealthy for the business, and I hope it doesn't come back.
I totally agree. I think for any firms that did diligence in 24 hours, they were slow. My question to you is that everyone says we will see this wave of down rounds. And then I saw this tweet from Albert Wenger at USV, and he said he's only seen 2 down rounds in his career. Obviously, he's a very gifted investor, so that might be part of it. But I was kind of looking at that going, they are so damaging. They are so impactful on company morale. Will we see the down rounds or will we not?
I think this time we will. I mean, look at what Stripe has done, right? If you're telling me every company from 2021 is better than Stripe, sure, there'll be 0 down rounds. But if that's not the case, there may be some. But Albert, I think, had some great insight, and he's a fantastic investor, which is they are complicated. They suck. People don't want to do them. It's actually a little bit against like the nature or the psychology of a VC. You want clean things that go up and to the right, incentives aligned. And so fewer down rounds happen than probably should happen because VCs don't like them.
I totally agree. Actually a concern that I have which is VCs with dry powder will keep on artificially inflating books and kind of stipend them to continue kind of enjoying the marks that they have. I want to ask, on the thread itself, you say about startups raising 2 years of cash in 21, 22, and needing to raise in 23, 24. Transparently, I have 50 companies, and I don't have a single one raising until Q3 24. Now, that's not me like bragging. That's just like them extending runway and like making it work until then. Am I wrong here? Because I'm not seeing this need to raise in 23 now.
Well, first of all, if all startups in the US and Europe and abroad have cash through 25, like your portfolio, God bless. That's fantastic. And I can just, fly to Hawaii and sit on the beach for a while. But the data we're seeing coming across our desks, the data we're seeing at IVP suggests otherwise. We're seeing, I would call it a trickle, but like a noticeable uptick from Q4 in deal flow. And we saw 2 potential down rounds this week. So like what I tweeted in my thread, we have the data to back it up. I think it's a question, does it become a flood in the second half of this year and what happens next year? Fair enough. Those are predictions. But we are seeing the market correct in real time and companies begin to come back to market right now.
Can I ask, what does your data show? You mentioned the data there and you mentioned the 2 down rounds that you saw this week. What does it show you and what are you seeing from what you see internally?
I think you have to sort of cleave startups into 2 camps. There's the ones that sort of lived in a bubble somehow. Maybe they hadn't raised in 20 or 21, or maybe they're just coming up and raising, a Series B, let's say, for the first time, versus the ones that raised in 20 and 21 at artificially high prices. And there could be some hangover effect. So, in the public markets, software companies, multiples there have corrected to what we saw in 2016, 17, 18 to normal multiples. So the question is that happening in the private markets? And the data we're seeing, the answer is yes. We announced multiple deals last year in 2022 where they were priced at something like 10 to 15 times forward ARR. And that's just those specific companies. It depends on all the specifics of a company, of course. Pricing is an art. But those were like not dissimilar prices. That's about where things were getting priced before COVID. And so for these companies that don't have the hangover from COVID, from those valuations, say in 21, things are back to normal. And so then the question is, what happens to that cohort of companies that raised in 20 and 21? And that's the open question. And that's what we need to see. And we're going to find out.
Can I ask you, I mentioned my portfolio, I have some of these in my portfolio, but we see many companies who raised a lot and have monster valuations, some as high as 1,000x ARR. Proud to have 1 or 2 in my portfolio. What happens to them, Tom? Do they grow into it? They have 10 years of runway. A lot don't really have product market fit. What happens to them?
My gosh, Harry, if every company could have 10 years of runway, you've constructed just the best portfolio on earth. So first off, congrats again on that.
No, because they don't have product market fit, Tom. It can take a lifetime to find.
Okay, so we have a very special perspective, right? We do Series Bs and Cs at IVP. We invest post-product market fit. When we see that, we invest. Sometimes it's pre-revenue, but we need to see product market fit. And for that class of companies that's sprinting towards something, they generally raise 2 or 3 years of cash. And so, they can cut and extend runway, but what happens to them? Listen, at some point you need growth to become a real company and not a zombie. So some of these companies, they're going to cut so much that they sacrifice too much growth and maybe the product market fit isn't great and they never figure out a way to hit the accelerator again and attract new capital, and they just go zombie mode, which isn't bad, but it becomes a lifestyle business. And maybe they pay their investors back or not.
You say about paying investors back. I've seen actually on a couple of rounds where investors have actually asked for their money back. Do you think we'll see that in waves?
Man, that could happen, but if I were an entrepreneur, I'm not sure why I would do that. Maybe there's a good reason. Maybe if you raised $1 billion and you only need 50 million, you can give some back. But I certainly hope most investors aren't asking for their money back. It's, hey, listen, it's a contract, right? Fair and square, and you have to live with the consequences.
No, I totally get you. Can I ask, you said now is the calm before the storm. So much poetry in this tweet thread. Why is now the calm before the storm?
the way I back into the math says that there's a lot of companies that are going to be raising the end of this year and next year. And what's going to happen is there's only so many hours in a day for the investors who do, say, A, B, and C rounds that are going to be following on to these things. And if everybody comes to market at once, people are going to have to be selective. They're going to have to triage their time towards whatever they think is the best company. And, it's just the effect of too many companies, too little time. And so I think, unfortunately, some founders might not get the attention, the time that they deserve to look at those rounds or maybe do the hard things like down rounds. And once again, that's why I'm trying to give the advice, don't raise at the last second, get out in front of it.
I totally agree. And so if we speak about getting out in front of it, quite often they'll go back to their initial investors, their existing investors. And I've got many friends who are partners at A, B, and C firms, and they're underwater with existing portfolio company re-ups, extensions. How does this change reserves and reserve management?
It isn't a big deal during good times. It's pretty easy because companies can raise capital, and you're really like, how much money can we make on our incremental investment, right? That's the psychology we've all been in for the last few years. But all of a sudden it changes during the darker times, right? Where it's, if I don't put money in, there's going to be, the company's either going to go out of business or there'll be a pay to play, and I lose basically all of my ownership. Pay to play means if you don't put in money in the round as an investor, your existing investment just gets crushed. It gets diluted massively. I think the trick is for investors, especially those who didn't live through the dot-com bubble or the great financial crisis, when they're putting together these bridge rounds, really just going back to basics and saying, what is this a bridge to? What are the milestones we're going to accomplish? Because too often, especially when I was an early stage VC, I saw bridges to nowhere, that would give companies a month or two of runway and, on some unfounded hope that they would sell the company within a month or two. A good bridge round's at least 6 months. So I would ask really hard questions about any bridge round that's, measured in weeks or a month or two.
Have you ever had a bridge round work? Bluntly, we both, despite my youth and good looks, I've been doing this for 8 years. I've never had a bridge round work. Still the optimist. But have you ever had one? And actually, do you not now think it's probably a bridge to nowhere 99% of the time?
In general, they're not necessarily the best use of capital in terms of a bridge round. I think that's what the math would show. Now, in my career, have I seen one work? Yes. At RRE, there was a bridge round we did for what is now a very famous fintech company that got the company to a sale. Ironically, though, in retrospect, that was just a good company. And they should have just raised more money and kept going. That company was Venmo. And so, it's probably not about whether it's a bridge round. Like, if it's a good company, give them a lot of capital. And if it's not, zero. That's probably the right decision framework.
No, I totally agree, and I like the simplicity, bluntly. You mentioned, get out ahead of it. The storm hasn't quite hit yet. When does the storm hit?
Here's how I back into it. I think a lot of firms or a lot of startups are going to be raising later this year, and that usually means like Labor Day, and everybody wants to get in front of that. So my guess is July and August, we start seeing a lot more businesses come to market, knowing that other businesses will be out in Labor Day. But yeah, it's just a guess, but predictions are fun.
And predictions are always fun. I've always learned that venture investors make the best armchair macroeconomists. And so I like to do predictions. Why do you think this will be? You said this will be worse than the GFC. I was like, wow. Why do you think this will be worse?
In the lead up to the great financial crisis, mortgages were going bananas. You had LBOs going bananas. Investors in venture weren't to the same degree. You didn't see companies in the public markets in tech or the privates trading at, hundreds of times revenue. I think the dot-com era was too fresh in people's mind for that to happen. But this time it did. So the hangover is going to be worse because, you were pre-product and you raised at 300 on a bunch of hype. And now you're at $1 million ARR, but you had to cut burn. So you're only going to go to 2 next year. What happens to that company? Is that an up round? Is it even a flat round? It's probably more a down round. We already covered that the psychology for a lot of VCs is not to do down rounds. And so man, those are tricky situations. And that's where I think a founder needs to be super proactive about figuring out the capital needs for the company and how to adjust that price in a way that's not going to, prevent them from raising that next round.
We're going to get to kind of the survival steps. I had Jason Lamkin on the show not too long ago, and he said anyone who joined a $1 billion startup as an employee in the last 2 or 3 years, I can't remember what his time frame was, but say 2 years, they won't make any money from their equity in 99% of cases. Do you think that's a fair assessment?
Oh man, maybe I'm an optimist, but I think it's a lot better than that. Why? Well, yeah, the initial equity grants could be underwater, but there's a couple things going on. One is those preferred rounds, that's a different thing than the 409A price that the options get set at. And I think the 409As may have been high, but not quite as high as some of the preferred rounds that venture firms did. So that's one thing. The other thing is it is in the power of the board and the CEO to figure out how to incentivize people going forward and make sure that employees are incentivized to stay and have upside. And so you can get creative there. And that's incumbent upon, the companies to make sure their talent's not going to leave, because if their equity is totally upside down, the best ones are going to be gone real soon.
So when the storm hits, we've got thunder and lightning. It doesn't look good, to carry that metaphor. What do the GPs do? How does this change what investors want in companies? And also, how does it change deployment cadence?
The deployment cadence is probably the first thing, and that's already changed. I think GPs saw that happening pretty quickly. So 21, there were a bunch of funds that deployed their capital in 9 to 12 months. And you say, well, why is that a bad thing? Why not just keep doing that? Well, because when you raise a fund, you generally tell your LPs, hey, it's going to take us, 2 or 3 years to deploy the capital before we go raise our next fund. And so that LP needs to allocate a certain amount of funds. Let's say they're an investor in your fund and they put, $5 million in, and they think they're going to put another $5 million in 3 years from now. But 9 months later, you said, hey, I need another $5 million. That depletes the books of the LP pretty quickly. Now, LPs start pushing back and they say, I'm not going to commit if you come back in 9 months. That's going to change deployment cycles. And VCs know that's already happening in the LPs' minds. So they're now saying, okay, I have to hit the brakes and I'm going to go back to that 3-year deployment cycle. And so that's dividing the dry powder out there by a third.
Do you think the LPs do push back when they do come back to market earlier and say, actually, we didn't budget for this and we can't make that commitment happen?
Unfortunately, I think that is going to be the comeuppance that a bunch of funds suffer. LPs are going to say no. We at IVP, we've been around for 43 years. We are very careful about our deployment, and we really didn't go all that fast in 21, and we didn't slow down that much in 22. This is like something we've been harping on as a firm, just tirelessly. But for a while, it didn't feel like, that was necessarily the winning strategy when everybody was trying to be an index fund, putting money to work as quickly as possible. There were times when we were like, man, are we doing the wrong thing by just being super selective and not trying to index the world? But,
for me, this is the first vintage where we'll really see temporal diversification be a true benefit. Over the last 10 to 12 years, there was no such thing. It was the same cycle. So I think this is where you actually see it. And I agree with you. I was incredibly slow, to the point where some LPs were saying, why aren't you doing more? Which I'm now pleased about. My question to you is actually on books and value of books. I'm an LP in funds. They're not marking their books down very much and very reactively, Tom. Do you think managers are marking their books down at all or aggressively enough for the LP class?
I can't speak to what most venture firms are doing, but I think everybody should have done some sort of markdown in the past 12 months for their venture investments. It's just, it's absolutely gravity. And gravity may have not been effect in 21, but it's certainly back and it's dragging things down. To what degree? Well, that's going to depend. Because you can't look at every private startup and say, how much would it be worth if it were public, right? Because by definition, the public markets wouldn't accept these things. That's why they're still young and private. So it's definitely an art. But if I were an LP in a venture fund and things were marked up or the same today versus 12 months ago, I would ask some good questions.
Can I paint a different picture, a potentially more positive picture, which is there are a huge amount of European family offices with no exposure to venture. I've spoken to 8+ endowments in this year who have sub 5% exposure to venture and want more. We have the UAE with, more money than ever, looking to deploy more and more than ever. I think the line is $1 trillion project. I'm sure there is a venture fund alone in financing innovation there. Is there not a new wave of LP that actually is born in these generations or this kind of economic cycle that we can be hopeful of raising from?
You make some really good points, and I would say it depends on your time frame. Like, if you zoom out, we're in the best industry on earth, innovation, technology. If you ask me, is venture as an asset class and technology, as an asset class, are they bigger or smaller in 10 years? The answer is obviously bigger. How about 20 years? Bigger. 30 years? Bigger. I'm an optimist on that. Now, but if you look, if we were to take a bet, Harry, are there more LP commitments in 2023 and 24 or 21 and 20 combined? I guarantee you the 20 and 21 number was going to be bigger than the 23 and 24 number if you really zoom into that small time scale. But over a longer time scale...
I'm not taking that bet. That's a bad bet. And you're right. This is clear, totally. On a longer time scale...
Yeah, on a longer time scale, things are rosy. Venture's amazing. Startups are great. But for the next year or two, there's this hangover. But we'll recover from it. Things will be fine.
Can I ask, a lot of people say there are so many funds, though, with so much dry powder. A lot of the big, funds raised last year, we saw their multi-billion-dollar funds. And, for me at pre-seed and seed, I don't have data that I'm drawing analysis from, but I'm just drawing analysis from, 15 companies that I made a week. Prices at the early stage are going nowhere. They are staying strong. And a lot of people are saying, well, the multi-stage funds have so much dollars and dry powder that actually maybe early stage will be immune from this. Do you think that's possible?
I think it's playing out exactly as the past couple crises, and it was kind of predictable. What happens is, here's the waterfall, right? Okay, public markets multiples correct. And let's say you're like a mutual fund and you do pre-IPO rounds. And companies aren't trading at 30 times revenue anymore. They're trading at 7 times. And some companies trying to sell you shares at 30 times. You're going to say, no way. I can't lose money on my investment, right? So they're the first to react, those folks who do those types of rounds. And then, the Series C investors, they say, I know the Series D investors, those mutual funds aren't going to pay up. So I have to get a markup. So I'm going to price down. That takes a few months. And then the Series B investors 6 months later say the same thing. And then, here we are 1.5 years, 2 years after the correction, and the seed investors get the memo. It takes time. It's what happened after the dot-com bubble. It happened after the financial crisis. It took a little time, but, I think it is beginning to happen. Now, are prices going to go in seed and Series A back to 2011 levels where, great companies were done at 1.5 pre? No. Not happening.
Sadly not. The truth is now everyone is searching for the magic L being liquidity. Do you think we'll see a massive rise in secondary selling and buying?
It's a good question. I'm not sure I have a crystal ball for that. I think secondary buying, though, tends to be hottest, probably at the worst times, right? That's when things are overpriced and, crypto's high and secondaries are high and all assets are high. On the other hand, liquidity is a good thing and it's a good force. And the idea of secondary was kind of taboo in venture not that long ago. And I think it's been a good thing. And I don't think we're, rolling back on that. It's a force that's here to stay. And so, how long does it take for secondary volumes to hit what they were a year or two ago? I don't know. But once again, in the longer run, are secondaries going to get bigger? Absolutely.
Can I ask you just advice? I didn't take cash off the table in some winners where I probably should have done over the last few years. And that was a big mistake looking back. How do you determine when's the right time to take some off the table? I find, everyone's like, lean into your winners. Bullshit. The best strategically lean out in stages along the way, I find. How do you determine when and how much to?
Oh man, this is probably the hardest part of venture capital, is deciding when to sell. And I'll be honest, I think it's been a learning experience for me, for the whole industry. And the key is you don't have to get it perfect. And so that means not trying to time things all at once and doing it in stages and de-risking over time. This keeps you from, making some really big mistakes. But, I do think if there's going to be a couple things you look at, one is going to be the specifics, the fundamentals of the company. How much do you believe in it? How is it valued? How are they doing it? And then the second thing is keeping in mind macro. If you really think a company's overvalued and the market's overvalued, then you're going to have a bias to action and a bias to sell. How do I feel right now? It feels like things are pretty fairly valued in the public markets. So I wouldn't be in a rush to sell everything that's not bolted down. We did feel a little bit like that in 21. And so we took a disproportionate amount of liquidity in 21. But now, it's kind of like, it really depends on your conviction in the individual name.
No, I totally get you, and well done for doing that in 21. I wish you'd messaged me and told me to do the same.
You gotta invite me on the show sooner. That was your fault, Harry.
That's totally my fault. Fuck. My question to you is, we're going to switch sides now and do the survival guide. This is for founders who are thinking about navigating these tricky waters in the ensuing storm. You said raise now or sooner than you expected. What I was thinking to that is okay, if I'm a founder, I have 18 months of runway. Do I raise now? Oh, if I have 9 months of runway, do I raise now? What is that point where it's nah, you should raise now versus no, build the fundamentals?
So it's a good question. My rule of thumb is you should start raising by 12 months. If you have 12 months of capital left, you're in the red zone. Now, does that mean you need to hit go and speak to every venture firm with exactly 365 days, to go? No, but it means your strategy is in place. And I think you should have the capital in the bank with about at worst, with 6 or 7 months of runway left. So don't start raising with 6 or 7, be done by then.
I totally agree with you. And I get nervous when they're at that state, I have to say. But yes, my question to you is, a lot of founders worry about going out and burning bridges, burning relationships by going out maybe before they quite have hit the numbers that they said they would, and then it's difficult to come back. I do always say that to founders, it's really hard to go to Tom in January and then come back in March or May or June, whenever it is. That second, you kind of know it's a smelly fish. Brilliant analogy. Do you agree with that? It's really difficult to come back.
You're absolutely right. There are downsides to going out to market and not raising, but you have to ask yourself 2 questions. One, which is worse? A slight stigma from not raising the first time, or going out late and not raising and have no backup plan? Because in reality, I think that's a little bit of the dilemma. You have to choose one path. And the second thing, though, why go back to the same investors? Segment your investor list that you're going to canvas and go to one set of investors, that first time where you're kind of testing the market, but don't go to everybody, and have a second set of investors, if that fails. So tier them. Don't contact them all at once. Go in waves.
I always say the best fundraisers are actually comedians. And what I mean by that is comedians test their audiences brilliantly well when they're in the early days, and they see what works, what resonates, what doesn't. And then they continuously adapt, and then they hit the main stage, and they've done it 10 times already. So they know the jokes that work and those that don't. I find it's very aligned to fundraising in that way. I do want to ask, you said one of your tweets was cut some more, but continue to fund core R&D. So again, I'm a founder asking you for advice. I'm 9 months of runway and I have the chance to cut and extend it. How much runway should I be cutting to?
Oh man, so it really depends. This depends. How far are you going to get? What are you cutting to? You have to define the objectives. It shouldn't just be based on time. It should be based on achieving certain milestones. Now, time certainly gives you the opportunity to hit more milestones. And maybe it's growing into your valuation, but I think that's where you have to sit down with your management team and the board and lay out a really, objective view of the world and what, milestones you're going to hit.
I totally agree. Can I ask, the first thing often to go in the cuts is marketing spend, customer acquisition, kind of growth funnels. How do we see marketing spends hit in this kind of leaning of company budgets and this reduction of spend?
I had a board meeting this morning with a company called Attentive and sat down with the CEO, Brian Long, who's just a fantastic founder. We talked about this very topic. How do you think about marketing during a downturn? And how do you lean in? And one of the tweets I had was about going on offense, and we'll think about that specifically related to marketing spend. And the truth is, the marketing spend that you have now is so much more powerful than the marketing spend you had, say, during 21. Why? Your competition has pulled back. They're not bidding on keywords, so the CAC is down. Competitors may have entirely pulled from the market. So you may not need the same level of dollars to achieve the same objective. And then the other question you have to ask yourself is, okay, if we were going to grow 70% and we pull some marketing back and save a bunch of burn, and now we're only going to grow 45 or 50%, what difference does it make? Is there a really strategic reason that growing 70% is so much better? Is it actually a land grab? Can you quantify that you won't be able to get those customers back in a year or two if you decide to hit the accelerator after raising your next round?
I absolutely love that, and I totally agree with you there. In terms of going on the offense, I find a lot of founders still on the offense with regards to valuation. And you said focus on survival, not on valuation. What's your advice to startups raising today? Again, I'm assuming this very hypothetical role of being in your portfolio, clearly hinting at something. So my question is, how do you advise me? Survival, not on valuation sensitivity. What's the advice?
Listen, as a CEO, your number one job, for a portfolio company, is not running out of cash. And so the best way, if you're going to go out and raise or you need more capital, is to get a bunch of term sheets, right? Convince people to put money in. Don't anchor those potential investors. It needs to be at the last round. It needs to be at X or Y. Go out and get term sheets, bid them against each other. If you only have one bid as a founder, only one term sheet, you've lost leverage. To the extent you can get multiple term sheets, then you have leverage and you control your own destiny.
How do you advise founders when they say, I love that, but I'm worried about shopping it, and I'm constantly nervous that the VC will feel like I've shopped their term sheet? How do they get multiple without the feeling of shopping a term sheet?
That's a really perceptive question, and I think that comes down to the relationship. Don't get to know the potential VCs 2 weeks before you raise. Spend time with them, get chemistry, make sure you want to work with them, develop trust. And then if you go to those venture investors and say, thank you for your offer, I'm running a process and I'm collecting term sheets and they're all due by Friday. I appreciate you putting this on Tuesday, but I need to, maximize the value for my company for every shareholder. And thus, we're going to see how many offers we get because that's my job as CEO. I think the VCs will respect that and trust you and realize you're doing the best thing for your company.
I totally agree with that. I always say to founders, VCs need a reason to move. Inherently, I find we're quite an apathetic class. Not over the last few years, clearly, but generally. And so I say put a deadline in place and then make sure that it's not too soon where you force them to a no, but it gives them enough time to do the work. Generally, 10 days out allows for people who would move to move and those that wouldn't kind of shit or get off the can, so to speak, in the UK. Would you agree with that, instilling a deadline to enforce a sense of urgency, and would you add anything?
100%. 10 days is a good deadline. Have a deadline. The only other thing I'd add, though, is if you really want people to have maximum conviction, 10 days is like the detailed diligence. But if they understand the business and they have a relationship with you, have that go first. That can take weeks or months. Get that done. And then, you've got a week or 10 days to review the numbers and, call any customers you haven't. But you're right. A deadline is super effective. Human psychology.
A fascinating one that you did tweet was bring on operators with experience in C-level or even a professional CEO. I agree, and I like the idea. The trouble is, they're expensive. So number one, like, why would they join a company with bluntly maybe potential runway challenges ahead and in a difficult spot? Why would great talent at that level join a company that is struggling?
Well, it's incumbent upon the founders to convince great talent to join any company. And so I'm not sure what advice I have other than be super compelling and get great executives, but a good executive pays for themselves, right? If you're hiring a great head of marketing, a VP marketing, and they cost $300,000 or $400,000, and you give them a $10 or $20 million budget or a $5 million budget over one or multiple years, like, think about that. Somebody who's new and doesn't really know what the efficient ad channels are for your product's probably going to waste a lot of money before they get it right. Somebody who's experienced may go in and hit the efficient frontier, on day one or day two. So good execs pay for themselves, but you probably can't have it all, right? You can't have, that amazing exec in every position. And so as a founder, I think like having some understanding of your strengths and weaknesses and of yourself is key. And you want to put those, experienced operators in those roles that most complement your weaknesses as a founder. And then you could hire, more junior people for the areas where you're strong.
Do you worry about ramp time? I hear you and I agree, but we both know that like search can take 3 months and then ramp time can take 3 months minimum, 6 months often really before you get like full and optimal performance. That's like 9 months. We're back to raising again if we've done the 18-month extension.
Yeah, there's not much way around that. These processes, bringing in great talent, it takes a long time. I mean, but that's why I think if you're an entrepreneur, you're a founder, you want a good board, because you know what good board members say, Harry? They're going to tell you, hey, I know your, head of sales is fine. They haven't missed a quarter yet. And that's why now is the time to go find one who's more experienced. You have to hire ahead of the need, and it's tough, but you got to hire ahead of people messing up.
One that you said though was, and it's related, but it's like unit econ over growth. Again, I'm relating actually to Jason Lamkin, but he said, no, today we want both. do you think like one is enough? And actually for founders listening, if they go, okay, unit econ, and then growth really takes a hit and it goes from, good to pretty average, does that excite investors though?
So you're right, you do need both, but it's a question of time frame and trade-offs, right? Because they're not mutually exclusive. So as I was saying before, you can have a debate. Should we grow 70% or 50%? If it's 0%, that's pretty austere. That may really hurt your chance of raising capital, but it might be the right answer, because if your product is broken and you're just pushing a rock up a hill because customers don't like it, maybe you should grow 0%, refactor the product, and be out of the market for a couple months and then go back to market and then hit the accelerator. So, I think you really have to look at the specifics. But the thing is, it's not a permanent decision. You can always grow again and show investors, hey, listen, our blended growth rate was only 25%, over the last 6 months. But the first 3 months we refactored our product. And then the second set of 3 months, we were growing super fast. We were growing, 50 or 100%. And so people care about the most recent data points, not the oldest data points. And you got to show them that.
I totally agree. I think it was Mathilde Collins said, you have to go out and fundraise when you're most confident in your business. And I know that's a luxury because you can't always time it, but I thought it was a good piece of advice. If you feel confident now, go now. So I totally agree and get you there, especially on the most recent data. What do you say about companies where their profile is often in marketplaces where you have to project your mindset forward to a different set of unit economics? This is the case for DoorDash, Instacart, I'm sure Masterclass in your portfolio, I'm making assumptions, but I'm sure where great companies, but you have to project out to see the beauty of their unit econ. How do you advise them in this different environment?
Well, you're right. Those companies have a greater challenge in terms of showing their unit economics. And I think that's where, though, there's a few things you can do. I think number one, you have to show just how amazing the addressable market size is. And that it's a risk, but it's a risk worth taking, because if you win the market, it's just worth so much money. So that's the first thing. The second thing is you can show the trend in unit economics over time, which is they were really bad before, they're pretty bad now, and tomorrow they're going to be pretty good, right? And investors can kind of infer what's happening. And then finally, you need to give them reasons to believe that the unit economics are going to get better over time, like really concrete data examples, and not just hopes and prayers that, hey, if we buy more of this widget or hire more people, the price maybe goes down. Uber did this well, for instance, by showing, hey, we're bleeding money left and right. But if you look at our oldest cities, these dense cities like New York, the unit economics are actually fantastic.
Yeah, no, I totally get you there. Speaking of kind of unit economics being fantastic in those cities, I'm intrigued. You said about kind of going on offense, and we spoke about it in related to marketing budgets. How do founders know when to go on offense? They've been through this cutting spree. When do they go on offense, and how do they strategically think about that with their boards as well?
I think it's like Maslow's hierarchy of needs. If you have enough cash that you're not worried about survival, then you can think about how to go on offense. So if you've cut to get efficient, you've raised more money, you're not worried about running out of money, then you can think about, all these tactics. And there's a lot of them, but, I think one of them is hiring great people. And you may be able to hire people you couldn't hire before, that engineer who, probably would have taken that job at Google. But, now Google has a hiring freeze, and so that person's in the market. And so your product team can go on offense by hiring better people. Your marketing team can go and spend in channels that you couldn't pay for before because the CACs were too high. And now you can broaden your reach. So I think you can examine every single part of your business for offense.
One thing that I'm worried about, actually, you mentioned people choosing, you over, say, Google because they're not hiring. One thing that I'm worried about is that talent retention within these large incumbents and a flight to safety. And what I mean by that is people who are there who would have joined startups or who would have started companies now are going, oh, I survived the layoff. I've got a child and a mortgage. Ooh, I'm going to stay at Google now. Does that worry you in the same way it worries me?
Yeah, listen, I think you're absolutely right. People are going to become more conservative, when times are tough. But on the other hand, the type of talent that is too scared to leave a big company might not be a good fit for a startup. And the type of talent that flees a startup as soon as you hit a rough patch, either in the company or the economy, they might not be the right long-term fit for your startup anyhow. And so I think you just got to be confident as a founder and not stress about these things too much.
So I'm always hiring investors for our funds. And everyone always tells me that in the last few months, oh, Harry, there's going to be a lot of great talent available. I mean, all of their carry has just been completely cut in half. It's going to be a great time. I'm not seeing that. They're quite happy with their large salaries. They're quite comfortable in these large funds. Do you think there will be this loosening of talent in venture with the carry being smashed as it will and has been?
I don't know. I think you nailed it on the head, Harry. There's countervailing forces. One is people are less tied to their current jobs in venture, but on the other hand, getting a seat in venture is super hard and it just got harder. So maybe you want to hang on to it. I think net, it means that people leave venture firms less often is my guess.
Yeah. The final step that you said was be decisive, half measures rarely succeed. What's a half measure, Tom, and what does that look like?
A half measure is usually something a management team lands on because it's easy. If a decision is easy, it's probably a half measure. If it's hard, if it's really damn hard, if it's controversial, you're probably doing enough of it. The other thing, a half measure often doesn't have an end result or a goal in mind. If you have a really specific goal and implementing that goal is difficult, that's probably, doing your job. That's probably what's necessary.
I like that differentiation. I want to move into a quick fire, my friend. So I say a short statement. You give me your immediate thoughts. Does that sound okay?
Absolutely.
So what did you believe last year that you no longer believe?
Last year, I have to say there was this meme that founders didn't want investors on their board, that governance wasn't important, and that founders just wanted cheap, easy capital. And I'm not sure I ever fully believed it, but I was damn scared that could be the future of venture. And, that idea is dead. It ain't coming back.
What makes you say that? Because I think founders still don't like board members, don't like boards, and would rather someone give them cash at a high price and sod off.
Well, that can work when the economy's good, but when you need to raise more money, a bridge round, or just building a company is hard and you need help interviewing and you need advice, you want that person who invested in your company to return your damn text message, pick up the phone at 11 p.m., talk to you on the weekend, and that's what a good board member does.
You're right. I think also what I've seen actually with a couple of companies that raised from some firms will remain nameless is their champion churned, and these firms were not really designed for venture, and so then they're real orphans actually, and that's uncomfortable. So I totally get that. What would you most like to change about the world of venture, Tom?
And I think venture is too hierarchical. We promote people too slowly, but a lot of the talent and the ideas come from people who are younger in their careers. And so I think venture firms need to promote sooner, give mid-level junior people more credit. It'll open up opportunities for more people to come into the industry, and it'll promote diversity across the industry.
Do you think people will open up carry pools for that?
I certainly hope so. I joined IVP because it's an equal partnership and we can be very generous with the carry here. And I certainly hope more firms move in that direction.
What's the trend that most investors are not seeing or ignoring?
I kind of gave this away in my thread, Harry, but I think the world isn't going back to 2021. And if you're a founder or an investor and you're waiting to fundraise because you think multiples are going back, you're just wrong. You need to get with the program. The best CEOs I work with got the memo very quickly and changed their minds with new data.
What's the hardest element of your role with IVP today?
Time management. Easy. It's easy to answer that because it's so damn hard. There's so much you need to do as a VC who's helping run a firm, and there's only so many hours in the day.
Spend time with your winners there who return the fund. Do you agree?
Yes. It's also oftentimes harder because they need less help.
Yeah. No, I totally agree. And bluntly, you always need great founder references. This is a cyclical economy. And so I totally get you there. What's the most crazy thing we saw happen in 2020 to 2022?
Oh, that's a fun question. I'm going to go ahead with SPACs there. You had pre-revenue companies that had bad business plans going public when they had no business going public. How did we think this would end? Of course, they were going to miss their projections. This totally bananas.
I mentioned my biggest mistake over the last 18 months was not taking liquidity off the table when I could have done. What would you say your biggest investment mistake of the last 18 months was?
The biggest mistakes in investing are not doing the things that make you a lot of money because the opportunity cost there so far outweighs anything else. So I feel like my biggest mistake in the last couple of years was not investing in an entrepreneur named George Fraser, who's the CEO and co-founder of a company called Fivetran. I do a lot of infrastructure investing, and I think he just created a generational company. And I looked at it a couple times and didn't get there at the end, and I missed out on hundreds of millions of gains.
Well, as we said at the beginning, you got to miss some to win some. So, chin up. Penultimate one. What's the best investment advice you've received?
I had a mentor named Eric Wiesen when I was at RRE. He's now at Bullpen Capital. Great guy. He said a couple things to me. One is have a bias to action as a VC. And two, trust your conviction. And so it's always scary to make a new investment. But if you have conviction and you're a selective sort of person, just do it. Don't look back.
What are you most hopeful for? And final one, we're finishing on an air of positivity. What are you most hopeful for when you look out the next 24 months?
Man, the answer for me is the same every 24 months, which is finding the great founders. It's finding folks like Brian Armstrong from Coinbase or Mitchell Arman and Dave from Hashicorp. These people who are changing the world and just have this incredible energy and ability to execute. If I find more people like that, our returns will be better, but I'm also just a happier person.
Tom, I can't thank you enough for this. I've absolutely loved it. So thank you so much for joining me today.
Thanks, Harry.
You are a star, my friend.